Hello, everybody, and welcome to episode one of the Lunar Finance Personal Finance Academy, where we'll be teaching you everything you need to know to become financially literate and get on the path to success. And today we will be discussing the topic of credit scores. Specifically, what is a credit score? Now, most of you know that a credit score is used to determine your credit worthiness, or in other words, when you apply for a loan or a credit card or a mortgage or any other line of credit, including student loans, the institutions will look at your credit score to determine whether or not to give you that line of credit. And not only that, but to determine what interest rate to charge for that line of credit. Now, the lower your credit score, the higher your interest rate is going to be, and the less likely you are to be approved for a higher line of credit. And the higher your credit score, the better interest rate you're going to get, or in other words, the lower your interest rate is going to be, and the more likely you are going to be approved for the line of credit. Now, the credit score ranges between the numbers 300 and 850. And again, they depict your credit worthiness. Now, a credit score. Hello, everybody, and welcome to episode one of the Lunar Finance Personal Finance Academy, where we'll be teaching you everything you need to know to become financially literate and get on the path to success. Now, today, we will be discussing the topic of credit scores. Specifically, what is a credit score? Now, most of you know that a credit score is used to determine your credit worthiness. Or in other words, when you go to apply for a credit card, a loan, a mortgage, or even a student loan, the institutions look at your credit score to determine whether or not to give you the money. And not only that, but to determine what your interest rate is going to be for that loan. Now, the credit score ranges between the numbers 300 and 850. The lower your credit score, the higher your interest rate is going to be, the more you're going to owe, and the less likely you're going to be approved for a higher line of credit. And the higher your credit score, the lower your interest rate is going to be, and the more likely you are to be accepted for a line of credit. Now, there are multiple different ways of calculating a credit score. First, you have the FICO system, which is made by the Fair Isaac Corporation, FICO, FICO, or you have the Vantage Score 3.0 system. Now, the FICO score is used mostly by institutions on your official credit reports. However, if you do use a third-party service such as Credit Karma or Free Credit Report, you will be receiving your score in the Vantage Score 3.0 scales. Now, the difference between these two is minuscule and they really do not matter. However, going on here, as you can see on the screen, credit score range 300 to approximately 600. You're going to be denied for a lot of applications, for a lot of loans that you're going to want to take out. You're unlikely to be approved for auto loans. So if you want to go out and buy a new car, it's going to be difficult. If you want a new credit card, it's going to be difficult. Um, it's really difficult to be approved for any kind of line of credit without facing severely high penalty fees for late payments or extremely high interest rates. Now, the best option you have if your credit score is within this 300 to 600 range is to apply for a secured credit card or a student credit card. Now, this will give you a very, very low limit. Somewhere in the ballpark of $100 to $500 would be your credit limit. And after using that secured credit card or the student credit card for a certain amount of time, eventually your credit score will rise and rise, and hopefully you'll be able to apply for higher lines of credit. Now, the second range is somewhere around the 600 to 670 range. Now, this is considered subprime. You're a subprime borrower. Now, in this category, you will be accepted for some more things. You might get accepted to more credit cards. Certainly not any of the credit cards that you might want with the high sign-up bonuses and rewards. However, you will be able to sign up for credit cards that are not secured and that are not co-signed or student cards. Now, at this level, you will face extremely high interest rates. There's just no ifs or buts about it, and you are unlikely to be accepted for high lines of credit. The next credit score range we have is somewhere around 670 to 730. Now, this range, you're likely to get approved. Your application is likely to get approved, whether that's for a auto loan, for a student loan, or for a mortgage. But you're not necessarily going to get the best interest rate. Um, However, the interest rates do range from low to very good interest rates to high interest rates. Now, this is the average range, and so your interest rate is really going to depend mostly on your reported income. The higher your income, the higher your line of credit will get accepted, and the lower your interest rates will be. Of course, there are some other factors, but again, there's this range is where there's the most variance. Now you have the 730 to 800 range. And in this range, you're likely to get approved for most lines of credit that you would apply for at a good interest rate. And not only that, but you might get some of the best interest rates. Again, if your reported income is higher, you will get a better deal. And finally, you have the 800 to 850 range. Now, if you're in this range, you don't have to worry about anything. You're going to get approved for 95% of the lines of credit you apply for. Of course, you can't just take out an exorbitantly high loan, even with this credit score, for no reason, but if you have a legitimate line of credit you are applying for, a mortgage, an auto loan, a student loan, you are likely to get approved and you are likely to get the best possible interest rates. So, for instance, if you're applying for a credit card, when you apply, you see that there's a range for the APY, you will most likely get the lowest rate available for that credit card. Okay. Now, the next thing we have to talk about is how the credit score is calculated. Now, the reason why this is important is because this is what determines your credit score, of course. And you need to know how your credit score is calculated in order to improve your credit score. The better your credit score, the more money you will save in the long term. So, your credit score is very, very, very important for those major life purchases. So, your payment history makes up about 35% of your credit score. Now, first we should talk about what your payment history is. Your payment history is ensuring that you are paying your lines of credit on time. So you're paying your mortgage on time, you're paying your auto loan on time, and you're paying your credit card off every single month. The more consistent you are with that, the higher your credit score will go, because the more trusted you are, you will build a record over time of a very trustworthy person who knows how to responsibly use credit. Now, before we move forward with the graph here, we should discuss a few of the other factors that determine your credit score. Now, this is also called the credit history, your credit history. The number of open accounts will affect your credit score. So, in other words, how many credit cards you have open and how many loans you have open, mortgages, car loans, etc. Every single line of credit you have, every single time you borrow, it is a new account, whether it's open or closed. Now, the way this is determined is solely your open account. So if an account is closed, it does not count towards the number of accounts you have or lines of credit you have open. Now, You would think that the less lines of credit you have, the better your credit score would be. But that is not the case. Your credit score actually increases with higher lines of credit. If you have 10 lines of credit, your credit score will be less affected negatively than if you have 2 lines of open credit. Now, this doesn't mean that you should just go out and apply for every single credit card that you can be accepted to, because another factor here is the age of your credit, or in other words, the length of your credit history. So, every single time you open a new line of credit, it averages out your credit history or your age of credit. If you opened a credit card a year ago and you open a credit card now, your average age would be 6 months. And so your age of your length of credit history would be 6 months. The higher this number, the older your credit history is, the more trustworthy you are. The more trustworthy you are, the higher your credit score is. So it's important, if you want to increase your credit score over time, to increase the lines of credit you have. And this can be as simple as applying for a new credit card. However, you have to keep in mind that every single time you do open a new line of credit, there is an inquiry onto your credit. Now, inquiries are important because they are another factor that determine your credit score. The more hard inquiries you have on your credit score, or in other words, every single time you apply for a credit card, a mortgage, or an auto loan, there is a hard inquiry on your credit card. And an inquiry lowers your credit score. However, it recovers over time. It is a temporary thing that lowers your credit score as a means of not applying for too many lines of credit, which is why it's important to maintain that balance between the number of lines of credit you have as well as ensuring that your age of credit is getting older. Okay, and again, last last factor in determining your credit score is the total level of your debt. And not only that, but your utilization percentage. For instance, if you have 1 line of credit at a $10,000 limit, let's call it a credit card. If your credit card is a $10,000 limit, if you use $1,000 of that currently, you have a 10% utilization rate. Now, that is not good. They want you to have less than 2 or 3% utilization rate. I would recommend keeping it below 5%, and your credit score will barely be affected. Now, with that said, the amount of debt you have in total as well is important, not just the utilization rate. So if you have $500,000 in debt, you are going to have a much lower credit score than if you have $5,000 in debt. And now we can move forward into this graph a little bit more and look at the percentage breakdowns for these factors. Again, payment history is 35%. That is the most important. So make sure you are paying off your credit cards every single month, your mortgage on time, auto loans, all that good stuff. Make sure that it's on time. And at 30%, we have the amount owed, or in other words, the level of credit and the utilization. Again, make sure that you are not taking on too much debt at one time, that you are capable of paying it off before you go out and take out another loan, and that you are not overusing the amount on your credit card, even if you have a really high limit. At 15%, you have the age of credit, or the length of credit history. Again, the older your credit history, the higher your score. At a 10% factor, you have the mix of credit, or in other words, the number of open accounts. Your credit score will go up if you have higher lines of credit, more lines of credit. And not only that, but if you have a mortgage, an auto loan, and a credit card, your credit score will be positively affected rather than just having, for instance, a credit card. Having a diverse mix of lines of credit also increases your credit score. And at 10%, you have new credit. So again, that's also in the lines of credit, the number of lines of credit you have, or the number of open accounts. So the number of open accounts and the types of accounts you have make up a total of 20% of your credit score calculations. Now, again, there are other factors in here such as that affect your credit score, such as inquiries that we discussed a while back. Now, moving forward with the topic of the inquiries. You might ask, okay, well, if my credit score goes down every time I apply for a credit card, how do I get a high credit score? If the more credit cards I have, the higher my credit score, but every time I apply for a credit card, my credit score goes down. How am I ever supposed to increase my credit score? Or how does that work? How does the math work out? And let me explain that to you right now. Now, this graphic here shows how long it takes for your credit score to recover to its base, its normal score, after some form of inquiry or event that affects your credit score. Now, as you can see here at the bottom, applying for a credit card. Now, as soon as you apply for a credit card, you have an inquiry and your credit score will go down by a certain amount of points. And it takes approximately 3 months for that to recover back to normal. So it's just a temporary thing to make sure that you are not over applying for lines of credit as a way to skirt the system. Now, you got some other factors here along with credit cards. For instance, every time you close a credit card, you get a deduction on your credit score because they like to see open lines of credit, and that will affect it for about 3 months as well. If you are late on a mortgage payment, that will hit your credit score significantly for about 9 months before it will recover fully. Now, if you completely default on a payment, completely, you're looking at an 18-month recovery time. A home foreclosure, if you have to foreclose on your home because you cannot pay the mortgage, you're looking at a 3-year recovery time to your credit score. And bankruptcies, of course, it depends on what type of bankruptcies, and we can get much more into that. There's Chapter 6 and Chapter 13 bankruptcies, and that will affect how long it would take. But it does take anywhere between 6 and 10 years on average for you to fully recover from a declaration of bankruptcy. Anyways, folks, I hope you guys learned a whole lot today about what a credit score is and why it is important to have a high credit score. Now, the amount of money you can save over your lifetime on all the different lines of credit you will make is significant. If you found this video helpful, leave your feedback and hit the subscribe button. We'll be releasing episode 2 of the Personal Finance Academy here shortly, and episode 1 of the Investors Academy. And from everyone here at the Lunar Finance team, hope you have a great rest of your day and stay smart, folks.